Right, welcome to our fourth session, which I think is turning into our final session for tonight, as we are trying to still close off this question from yesterday. And I think we'll have to push that mergers and acquisitions on the tomorrow. Right, so our fourth session being recorded again, and I was asking what was our best rate that we found from part 2 of the question last night. So again, we were buying, right? We're receiving our euros. The bank will be buying the euros, so we will be buying the dollars. And it depends on how we did the quotation. These were prices of the euros being the base. And I should have had a comparison somewhere. Did we compare it and see? So the low spot rate, we just said we'll be buying dollars 20 million. We need to convert this to a lock-in rate. So we found a lock-in rate. And so inverting it to the rate to compare. So if this is the rate for the euros, again, that's the rate we're going to be selling our euros at. So if we could think about it like that, we would want to sell for the highest rate possible. So up here, the forward hedge would have given us 1.1559, futures hedge 1.561. So 559, 561 is higher. And down here, 1.12, that's way worse. So we'd want to choose the highest one. Did I outline that anywhere? Effective rate? No? So again, that is the outcome of the hedge, the final recommendation, right? So this 1.1249. I'll stick with this one. So presuming that we didn't do all the cash flow working, and we stopped here and make our comments. I think I had to put in the closing comments. So in the closing comments, I'll just put the three together. So it seems thus the best hedge will give us the highest rate for selling our euros and this will result from, so lining up the three of them, the forward, futures, options, so just taking those three back. Using this one up here for the options, 1.1249, 1.1249. These are amounts of dollars per euro. And up here 1.1561 for the futures contracts. 1.1561. 1.1561. And for the forward contract, 1.1559. Right. 1.1559. So, which is the highest of these? Come on, now that we have them right next to each other. The highest of those three is not the forward. Try again, Amar. the futures. 61 is bigger than 59, right? So thus the best hedge is the futures hedge, which locks us into an exchange rate. We will, however, be unable to take advantage of a favorable rate movement if this occurs. Only the option hedge does not lock us into a fixed exchange rate. Right, so with all of that out of the way, we have now picked this 1.1561, which I will now take forward to our calculations today, excuse me. So from, I will probably, this is a little note before I could put that number in there. From the sale of the equity investment, we have this value in euros. Let's pull that value from the case now. Having sold this equity stuff, what did we get in euros? Good, 20 million right there. So we're pulling that now and to exchange it at that rate we just identified. So from the sale of the equity investment, euros 20 million, we will convert at our best hedge rate. Now, if you did the old way or the kit way of answering, or the examiner's way of answering this, you would have had a cash flow value already. But I'm following through with my method. With my method, I said you could avoid dealing with that cash flow stress and just find the best hedge rate. But this now leads me to this statement or this position where I must now finally convert my hedged amount into a cash flow value, because I need to add it or take it, add it into my free cash flows. Convert at our best hedge rate, or in other words, sell our euros. That is 20 million euros multiplied by what we had on the previous page, $1.1561 per euro. Right, make sure everybody okay with the multiply to convert it. $1.1569 per euro. And what will that get us? How much cash are we collecting? Good. And I'll drop it down to 2 decimals. 23.14 again, million dollars. Right, let's compare to what they used. They used 21.642. Wow. 20, hold on. 21 dividend capacity before transfer required funds from sale of investment. Yeah, 23.118. So we are on the ball. How you got 1, 2 there? 1569. 1, 4. Everybody good with the 1, 4? Yeah? Somebody want to use their mic? Feel free. Chat if you need to. Great. So, yeah, back up there. So again, it's that plus 23.14. Again, I could say note 1 or something. to indicate that's where we went and worked this out. Note 1 here, right? And it's that plus that, and we now have to minus 40. So what will our free cash flow be for our 2017 dividend? That plus that capacity for transfer to project. All right, 4.78. Now something looks a bit, yeah, 4.76. That's fine. That's not funny. That's great. 4.76 looks very much simpler than the way they try to explain it on the answer sheet. Any queries at this stage? Now that we have this $4.78 million, we still do not have a dividend per share. And finally, let's throw that in. Throw that in right here. Moving this note down a little further. Thus, the DPS, dividend per share, in 2017 is $4.78 million divided by how many shares do we have in 2017? Do we know? Number of shares. Did the number of shares expect to change? I think we're sticking with the 80,000. Yeah. So there's no indication of any change in the level of shares. Transfer. $4.760. Just double checking here. Divide by 80. Well, that's 80,000. So 4.78 is million. So that's really 80 million as well. 0.595. Beautiful. Exactly what they have. So we are on the right track. Somebody do the division for me. So remember, it's 80 million. Huh? So many million divided by 80 million. That will now get us 80 million shares equals. Right. So dividend, and we're sticking it to 2 decimals again. That's where we had up above, yeah. 22 cents, 31 cents, how many cents? 60 cents? No, 0.6 cents. Yeah, right, 6 cents. All of that work for 6 cents, people. My goodness. Right, 6 cents. So many dollars. 6 cents for every share. 80 million shares. Right, so this is our dividend in 2017. 0.06, which we'll now discount for 1 year. And the same thing will apply to 2018. And of course, we'll have to discount that, excuse me, for 2 years. Everybody get here? So again, taking back to the question again to read exactly what we just did. Year to February, remaining cash flows will be paid as dividends. Year to February 18, the dividends paid will be the same amount as previous. So I had the years a little wrong side here, but really we know where we're going, right? So 2018 came after 2017, and it's all 6 cents. So come on, discount your 6 cents and give me some values. And the final value here would be our company or share value after the investment. So get those 6 cents and discount them, then add them all up. 0.5 is which one? Both of them? 2019. No, not 2019. 2019 was 22 cents. 2017. 17, 0.05, and 2018. Same thing? Yeah, so slightly, well, 47. Yeah, we chose to stock it to 2 decimals. If you want to do 3 decimals, that will then change up the whole story. But I'm going to stick to my 2 decimals and not stress over that because it's all approximations anyway. So add it up. If you choose to go doing your 3 decimals, that's fine. My only word of warning there is you will be dealing with time constraint, writing more numbers. Choose 2, stick to 2, finish your question, move on. All right, so that's my advice. So 5.04, whether that's off by 2 cents, 3 cents, nobody cares. You finish the thing and you move on. So to conclude now, whether that's off or not, whether you use 3 decimals or not, coming back up here, what was our value? Where did we go? Without the new investment, we ended up with DVM, and 4.51. So that was our P0 without the investment. So compare that to that now, 4.51. Compared to before the investment of 4.51. So what's our concluding comment? Did the project add value? Come on. Did the project add value or not? Yeah. Or investment. At the investment added value as the share price was increased. Right. End of part. That part. Trading rules. Okay. So really, people, that's just wow. Right. For 8 marks, that's just horrendous. Right. So if you could sort of just figure it out, write up something, move on, because you have a whole lot more of writing to do. Right. Part 4, issues of the proposed investment, and part A, which we didn't look at last night as well. I want to spend a few minutes to close off tonight's session looking at those 2 bits, right, before we close off. I wanted to do that on the mergers and acquisition question, but it's a little too much now. Right, so that will probably take us till after 12. So of course you all feel free to try it out, especially those who are now on study leave. Good for you. I still have to go to work tomorrow. So let us look at some of these concepts and we will close off there. Right. So any queries once more with this computation? Everybody okay? Starting from not having a clue of what to do, but yet now using the hints given in the question. They tell you do something with the dividends. what with the dividends. It had to come back to what we discussed up here. I wrote this out up here before Stacey joined us. So using the dividend information to find the added value, that's what we were started with. And then we had to figure out what sort of thing we can get from dividend to give us value. And the only thing is dividend valuation model gives us a value, so that with that we can find the share price before, and using the additional information in FCFE, again via DVM, we can find the shares after, and that difference will be the indication of the added value, either on a per share basis. Of course, the examiner answer went on to calculate that times number of shares, 80 million. I mean, why are you multiplying those two share values by 80 million? It's a simple comparison. You either compare per unit or in total, and you do not have to do both. So you save yourself that time, right? And that's where we went dealing with all of this. Wow, that was really, really, really something. All right, so back to party. Now I want to use here the examiner's answer, which I had cut out and thrown up here. And once more, let's see if there's any fluff in here. And also, I like how they brought it out in the report, that's the part B, where they actually, after some little background stuff or so, or maybe even some of this was from the computations, but that you could have easily left for behind and started off saying that the possible issues that would have affected the calculations. And you start with that section here, part 4 of your question, and get all of this wonderful theory done and out of the way before you get stuck into figuring out whether DVM would be used or not. All right, so let's go back and start with A. A, again, some wonderful theory. Let's just refresh with a question. With reference to purchasing power parity, explain how exchange rate fluctuations may lead to economic exposure. So, do people remember those phrases? Purchasing power parity, economic exposure. Could somebody briefly outline quickly what is economic exposure? Come on. And not when we're exposed to the economy. No. You have to be more technical than that. And theory, people, remember, theory for Friday. You cannot pass this exam with calculations only. That's the stark reality that you have to deal with. So you have days to spend with the theory. And as I mentioned, if we just spend time reading everything in that kit, all those theory bits, and hopefully if it sticks, you will be in a good place. All right. So, risk of adverse exchange rate movements, not good enough, Kinesia. Come again. That is a phrase. I want a short sentence. You could do a sentence, and in your phrasing, you've left out a key element in terms of the time zone that you need to use to define economic exposure. Changes in the present value of cash flows due to unexpected movement in the present value. Your time zone, Stacey, is missed out again. So the two contributions, still two phrases, but that's not so bad because I just wanted a quick item. But both phrases are leaving out the time zone. Present value of which cash flows, Stacey? Right? So again, if you just stick in the word future in there, that would be a bit better in terms of saying it's not something that we are accounting for right now. That it is these future cash flows, and that is where economic exposure is. Right? So yes, caused by the change in the rate movements, yes, both parties had that, but it's that change in the value of these long-term cash flows or future cash flows. Right, so how does PPP come into this? Purchasing power parity. Which one is PPP again? Is that the one with interest rates? Something rates PPP bring into play that we'll have to now discuss. Come on. Does the PPP work with interest rates? Yes or no? No. Excellent. It is the inflation rates. Very good. So now let's scroll to the answer. So PPP predicts the exchange rates between the two currencies on a relative difference of their inflation rate. So this is good stuff so far, right? No fluff here yet. Therefore, if one country has high inflation rate compared to the other, then its currency is expected to depreciate. Is everybody up to par with that? Make sure that's your basic, that you need to know what your PPP is. And however, according to PPP, the law of one price works because any weakness in one currency will be compensated by the rate of inflation. Any weakness in the currency. So is that direct relationship between the currency and inflation is where the whole model comes into being. All right, so no real fluff so far. Economic exposure refers to the degree by which the company's cash flows are affected by fluctuations. And they sort of follow along Kinesa's here and Stacey's as well, where they do not stick in the word future, and you really, to me, need to complete that by having the word future. International competitors. I'm tempted to say that second sentence is fluffing, but it's not so bad. I'll live with it for now. Further, so I just want to include the word here, companies, future cash flows to update that. Right, further. If it holds, then the company may not be affected by exchange rate fluctuations, as lower currency value can be compensated by the ability to raise prices due to higher inflation levels. This depends on markets being efficient. So, yeah, this is where the crux of the answer is coming in, because prior, all we did up here was define PP and then define economic exposure. And this is really where the key discussion is coming in, how one affects the other. However, a permanent shift in any exchange rates may occur, not because of this relative inflation rate differentials, but because the country or group of countries lose their competitive positions. In this case, the law of one price will not hold, oh my, and prices readjust to the new long-term or even permanent rate. For example, US to UK declined, and we don't have to go back to the 20th century. As the US grew stronger, the UK grew weaker. The rate reached almost parity in 1985 before recovering since the financial crisis in 2009. So what is the item we can relate to here, which again caused the UK pounds to weaken recently? And when I say recently, I mean, was it this year or last year? One out of the two. Come on, the event starting with B. Brexit, very good. So you could bring in Brexit here as well and part of that discussion to mention the same thing. In such cases, where the company receives substantial amounts of revenue from companies based in countries with relatively weak economies, may find it that it is facing economic exposure and its cash flows decline over the long period of time. Right? So again, yeah, that's just looking at the outcome of having the stronger currencies. So you're going to collect less of your currency if their value is falling. Right, and of course vice versa. So it depends on which way the rates move. So identifying where the risk would come from. So I think this answer could be updated a little bit, but how much marks again going for all of this? Only 6 marks. So throw those values at it, and our 10-minute warning is up. And I think by the end of that, we should be okay with this part 4. So part 4 now discusses the issues of the proposed methods of financing, which need to be considered further. So for this additional 9 marks, we want to now look at these issues. So of course, the introduction and so on here would suit well. And again, issues coming up very early in the report. And I still say you could have even brought that up above without throwing in any of those numbers. So let's begin. Dividend valuation model based on a number of factors, such as an accurate estimation of dividend growth rate, non-changing cost of equity, and predictable future dividend stream growing in perpetuity. In addition to this, it's expected that the sale of the investment will yield us €20 million. But this amount could increase or reduce in the next 3 months. The dividend valuation model assumes dividends and their growth rate are the sole drivers of corporate value, and that's probably not accurate. So yeah, that's a lot of stuff in there. If you can summarize that somehow, or break it up into points, break it up into separate sentences, which it has a few, and separate each sentence with a space, that would be better. Next issue. Although dividend irrelevancy theory proposed by M&M suggests that corporate value should not be affected by dividend policy, in practice, changes to dividends do matter for 2 main reasons. One, dividends are used as signaling, and any unexpected change in dividends or even in growth rates are not viewed positively. And then changes in dividends may signal the company is not doing well and may affect the share price negatively again. Right? So 2 main reasons. They already looked at one there, which was signaling. Maybe this here is a second reason. Corporate, yeah, that's what it is. Corporate dividend policy attracts certain groups of shareholders or clientele, and this is due to personal tax reasons. That is the key reason I was waiting for. So the tax effect of paying dividends versus not paying dividends. For example, higher rate taxpayers prefer little or no dividends, and lower rate taxpayers prefer higher dividend payouts. Change will result in excessive in pockets of negative share price volatility. So once you change a dividend stream, the party who does not like it would now sell your shares, and the parties who do like it, they might now invest in your shares, and this is the changeover that they're talking about. They did not do a detailed example of why higher rate taxpayers prefer low dividends and lower rate taxpayers prefer high dividends. So that, I think, another little one line I could stick in there. Does anybody remember that reason? Why do high rate taxpayers don't care about dividends, whereas lower rate taxpayers want more dividends? And again, it's dividends compared to simply your share value increasing. Anybody with that theory? Capital gains? No. We are comparing it with capital gains, Stacy. So we have to come up with the reason why it is preferred instead of capital gains. So capital gains is not the answer. Why do they prefer low dividends instead of capital gains? Why do lower rate taxpayers prefer high dividends instead of capital gains? So come on, try again. Anybody? Nobody? Dividends are taxed at a lower rate. That is where we're going. All right, so very good, Amaris. So that, again, it needs a little more than that, but that is the starting point. That's the starting phrase for the sentence, which we could stick in saying that since higher rate taxpayers have exhausted their lower credits, right, or lower bands provided for dividends, they will be paid the high tax either on their dividends or the capital gains. However, the lower rate taxpayers will now have the capacity to pay less tax on their dividends compared to capital gains, right? So the higher rate taxpayers lose that capacity because they are outside of that bracket, which allows that lower level tax. So they don't really care. But the lower rate taxpayers, they know that if they collect dividends, that will go at a low rate. And if they collect capital gains, that will go at a higher rate. All right? But that makes no difference to the higher rate taxpayer. They're outside or have lost that benefit. Right? Is everybody okay there? So that's the difference between a higher rate taxpayer and a lower rate taxpayer having the availability to that tax credit or not. And the last point, it is not clear why the board would rather not raise the required finance through an equity or debt. I mean, really, that's one of the key things by keeping our 80 million shares constant, so they're not selling more shares. The board may have considered increasing debt to be risky. However, given the current level of debt is 70 compared to market capitalization of 360 million, a little 40 million wouldn't really hit that. So it may have been concerned that going into the markets might give a negative agency type issue. So the answer continues down there. And such as having to make proprietary information public and so on. So, or being forced to give extra value to new equity owners or any negative signals. So I guess that's some reasons they're coming up with some issues to consider. However, what did we get from the question about that capacity? 70 million here. So you have 80 million $1 shares and 70 million in bonds. So remember, this 80 million $1, this is the par value, the book value. So it's not really that value that you're looking at. So the value of equity, really, it's not, equity to debt is not as close as this. This makes it look 80 to 70 as very close. But remember, the remember the values we calculated was something like $4 and $5 per share. So that would boot this up to a very large equity value. Everybody okay? So again, I didn't calculate the total values. That's what they were referring to with their 360. 80 by 4. 80 by 4. 320, somewhere around there, right? So they use the cash value. I use the unit value. Right, and that is where we will end. Yeah, somewhere over 300. Thanks, Amar. So that is where we will close off tonight. So we have now finished this question 1, seeing how horrendously long it can be, right? But again, people, use your theory as your greatest weapon, as well as the notation element or the narration elements of your computation. If you get stuck in a question, it is better to leave it with the narration and move on, rather than to try fighting up with the calculation and you do half a calculation. All right, folks, good night, and the meeting will drop off shortly, but we could also always come back and chat if people need to chat. So I will end off this recording here. Thank you very much, and good night.